Hey everyone, welcome back to the AI Tech channel. Today, we're diving into a prediction that's shaking up the global economy. Deutsche Bank says that by 2025, China will be outcompeting the rest of the world. Seriously, outcompeting everyone. That's less than 2 years away. Is this just hype, or is there real substance behind this claim? What does it mean for your investments, your job, and the future of innovation? We're going to break it all down. Buckle up, because this is going to be a wild ride. So, what's the buzz all about? Deutsche Bank, along with Goldman Sachs and other major financial institutions, is becoming increasingly bullish on China. They're pointing to China's rapid advancements in AI, particularly in areas like image recognition, natural language processing, and machine learning. They believe this AI revolution is going to supercharge the Chinese economy, giving it a significant competitive edge. This isn't just about manufacturing anymore. It's about high-tech innovation. We're seeing foreign fund managers pouring money into Chinese equities, especially tech stocks. Hong Kong stocks are rebounding, and the Nasdaq Golden Dragon China Index is on the rise. Even ETFs tracking A shares and H shares are seeing renewed inflows. The smart money seems to be betting big on China. Let's break down the immediate impacts. First, we're seeing a massive influx of foreign investment into Chinese equities. Think about it. Big players like hedge funds and sovereign wealth funds are shifting their portfolios to take advantage of what they see as undervalued opportunities in China. This increased demand is driving up stock prices, particularly in the tech sector. Second, we're seeing a rebound in the Chinese stock market. After a period of uncertainty, investors are regaining confidence, fueled by positive assessments of China's AI development and overall economic competitiveness. And third, Goldman Sachs is anticipating that AI-driven efficiency improvements could lead to a valuation uplift for Chinese firms, potentially narrowing the gap with U.S. peers. This is huge. It suggests that the market is starting to recognize the true potential of Chinese innovation. Now, here's a wrinkle in the story. Consumer price inflation in China rose faster than expected in January. That means consumers are spending more, which is generally a good sign for the economy. However, it also raises concerns about potential inflationary pressures. And on the other hand, producer price deflation points to challenges for manufacturers. How will China balance these competing forces? This is something we need to watch closely, because it could impact corporate earnings and overall economic growth. Adding fuel to the fire, we're seeing major UK-based hedge funds like Aspect Capital and Man Group expanding their presence in China. They're registering new products and seeking to capitalize on the opportunities presented by the booming Chinese economy. These firms are bringing their expertise and capital to the table, further validating the bullish sentiment surrounding China. They're not just dipping their toes in the water, they're diving in headfirst. Okay, let's zoom out and look at the second-order impacts. What happens when all this investment and optimism translates into real-world changes? First, we can expect to see even more growth in the Chinese AI sector. This means more innovation, more breakthroughs, and more competition. Second, global companies in various sectors will face increased competition from Chinese firms. If Deutsche Bank is right, and China is truly outcompeting the rest of the world, then companies in the US, Europe, and elsewhere will need to step up their game. This is going to be a major shakeup for the global economy. Third, we could see significant shifts in global investment strategies. If more investors adopt a contrarian approach, selling U.S. tech and buying Chinese assets, it could lead to a reallocation of capital on a massive scale. This could have profound implications for the stock market and the global financial system. And fourth, if Chinese companies continue to deliver superior value and quality, global supply chains could shift even further towards China. This would have a significant impact on manufacturing and logistics around the world. We're already seeing this trend, but it could accelerate dramatically in the coming years. Are your supply chains ready for this shift? Are your competitors adapting to this new reality? Now, let's talk about DeepSeek. This Chinese AI company is being touted as a potential game changer. Its technology is attracting significant attention and investment. But is this hype justified? Is DeepSeek truly a world-class AI innovator, or is it just a flash in the pan? This is a crucial question, because much of the optimism surrounding China's AI capabilities is riding on the success of companies like DeepSeek. We need to dig deeper and understand the true potential of this technology. All right, let's go even further out and consider the third-order impacts. What are the long-term consequences of China outcompeting the rest of the world? First, we could see increased employment in China, as growth in the AI sector, manufacturing, and financial services creates new job opportunities. Second, this could exacerbate existing trade tensions and lead to new trade disputes. If China's economic competitiveness continues to rise, other nations may feel threatened and resort to protectionist measures. This could trigger a global trade war, with devastating consequences for everyone. Third, we could see a significant shift in the global economic power balance. A sustained period of Chinese dominance could reshape international relations, alliances, and global governance structures. This is a geopolitical earthquake in the making. And fourth, if investment and talent flows increasingly favor China, it could impact innovation ecosystems in other countries, potentially slowing down technological advancements in those regions. We need to ensure that innovation continues to thrive around the world, not just in China. This requires investment in education, research, and development, as well as policies that promote competition and entrepreneurship. Okay, now for the reality check. While the outlook for China is undoubtedly positive, there are also significant risks we need to consider. First, there's the risk that AI breakthroughs are overhyped. The actual application and monetization of AI technologies may face unforeseen challenges. Second, the Chinese regulatory environment is subject to change, and government policies can significantly impact specific sectors or the overall market. Third, underlying economic challenges in China, such as real estate debt and demographic trends, could hinder growth. Fourth, there are ethical considerations, such as concerns about human rights and data privacy. And fifth, a global economic slowdown could impact China's export-oriented industries and overall economic growth. Let's talk more about those ethical concerns. Some investors may be hesitant to invest in China due to concerns about human rights issues and the potential for complicity in unethical practices. The rapid development of AI and data-driven technologies in China also raises concerns about data privacy, security, and government access to personal information. These are not just abstract concerns. They have real-world implications for investors and consumers alike. We need to demand transparency and accountability from companies operating in China. It's interesting to note that even Norway's sovereign wealth fund, one of the largest in the world, is considering a contrarian strategy of selling U.S. tech stocks and buying Chinese assets. This suggests that even the most sophisticated investors are starting to see the potential for outperformance in China. But is this a wise move? Is it too early to jump on the bandwagon? These are questions that every investor needs to consider carefully. So, what's the bottom line? Deutsche Bank's prediction that China will outcompete the world by 2025 is a bold one, but it's based on real trends and developments. China's rapid advancements in AI, its growing economy, and its increasing global influence are undeniable. However, there are also significant risks to consider, including regulatory uncertainty, economic challenges, and ethical concerns. As investors, we need to be aware of these risks and make informed decisions. Are you ready for 2025? Are you prepared for a world where China is the dominant economic power? Let me know your thoughts in the comments below. And don't forget to like and subscribe for more in-depth analysis of the AI revolution. Thanks for watching.